Good morning. Today we are initiating coverage on a highly asymmetric opportunity within the enterprise software sector, specifically focusing on a fundamentally mispriced SaaS CRM platform. While mega-cap tech dominates headline flow, our proprietary screen has identified a mid-cap entity, demonstrating a massive divergence between underlying operating metrics and public market valuation. This platform is currently capturing enterprise market share through a highly disruptive pricing model and superior product architecture. Our initiation comes with an overweight rating and a 12-month price target that implies a 45% upside from current trading levels. The crux of our thesis rests on an underappreciated revenue CAGR, robust unit economics, and a valuation multiple that reflects an unwarranted discount to the peer group. Let us unpack the quantitative drivers behind this compelling thesis. Evaluating the broader market dynamics, the global SaaS CRM total addressable market continues to expand, projected to reach $130 billion by fiscal year 2028. However, the structural tailwind we are tracking is the accelerated migration of mid-market enterprises away from legacy systems towards agile, AI-integrated platforms. This specific segment is compounding at a 22% annualized rate. Our subject company has carved out a serviceable obtainable market of $12 billion within this niche. More importantly, their AI-driven module attach rates have increased by 400 basis points year over year, indicating strong pricing power and product market fit. The structural setup here provides a massive runway for organic growth without requiring excessive capital burn to acquire market share. Turning our attention to the top-line trajectory and margin profile, the fundamental data is exceptionally robust. For fiscal year 2023, the company reported revenue of $185 million, representing a 42% year-over-year growth rate. Crucially, they are crushing the Rule of 40, currently scoring a 46, which is elite territory for a SaaS operator in this macro environment. Gross margins have expanded to 81% in the third quarter, driven by economies of scale and their cloud infrastructure compute costs. Additionally, the customer acquisition cost payback period has compressed to just 11 months. This velocity of capital return allows management to aggressively reinvest in sales and marketing with highly predictable ROIC parameters. Institutional investors know that SaaS valuations are anchored by cohort stickiness and land and expand economics. Here, the metrics are best in class. The platform is posting a net retention rate of 128%, firmly placing it in the top decile of public SaaS comps. Gross retention remains highly stable at 97.5%, effectively neutralizing churn risk. Through strategic upselling of premium workflow automation tiers, average revenue per user has expanded by 18% year over year. When we isolate the enterprise cohort, annualized churn sits below 2.5%. This demonstrates immense platform stickiness and high switching costs. The compounding effect of this NRR profile provides exceptional visibility into future cash flows and dramatically lowers the hurdle rate for new logo acquisition. The underlying technological architecture provides a tangible competitive moat. Unlike legacy incumbents burdened by technical debt, this platform utilizes a modern microservices architecture, enabling deployment speeds that are roughly 3 times faster than the industry average. At the core is a proprietary graph database, optimized for real-time data ingestion, which is critical for their predictive AI modules. Furthermore, an API-first development strategy has yielded seamless ecosystem integration, allowing enterprise clients to embed the CRM directly into existing ERP workflows. This deep integration fundamentally alters the vendor-client relationship, transitioning the software from a discretionary operating expense to mission-critical infrastructure. This architectural superiority is the primary catalyst driving the elevated win rates against established mega-cap competitors. Examining the balance sheet health and cash flow generation, the liquidity profile is pristine. The firm carries zero long-term debt and holds $210 million in cash and equivalents, providing substantial downside protection and optionality for strategic tuck-in acquisitions. Unlevered free cash flow margins currently sit at 14%, demonstrating that the growth is not being subsidized by unsustainable cash burn. Leading indicators are equally bullish, with calculated remaining performance obligations up 38% year over year. We are also witnessing clear operating leverage, evidenced by a steady decline in sales and marketing expenditures as a percentage of total revenue. The transition from cash consumptive growth to self-funding cash generation is a critical inflection point for multiple expansion. Let us shift to the valuation methodology. On a relative basis, the equity is severely mispriced. The stock is currently trading at just 4.2 times enterprise value to next 12 months revenue. This is a massive discount compared to the peer group average of 7.5 times. Projecting forward, our model indicates an EV to EBITDA multiple of 24 times for fiscal year 2025. When factoring in the growth rate, the PEG ratio is highly attractive relative to large-cap SaaS alternatives. The market is currently pricing this asset as a commoditized software vendor, completely ignoring the superior growth, margin profile, and cash flow inflection. Mean reversion to the peer multiple alone represents substantial upside before factoring in any forward earnings beats. Overlaying the fundamental analysis with price action and institutional flow reveals an optimal entry point. The technical chart displays a massive base building formation right above the critical 200-day moving average, signaling exhaustion of seller supply. From a flow perspective, 13F filings indicate that institutional ownership increased by 12% in the third quarter, pointing to quiet accumulation by smart money. Short interest remains negligible at merely 1.8% of the float, suggesting the sell side sees little downside vulnerability. Additionally, the volume profile indicates a massive liquidity shelf and strong support at the $22 level. The confluence of a technical floor and fundamental momentum sets up a highly favorable risk-reward asymmetry for portfolio managers. To maintain objectivity, we must strictly evaluate the risk disclosures and formulate a bear case scenario. The primary headwind is macroeconomic compression of enterprise IT budgets. A prolonged recessionary environment could extend sales cycles and delay large-scale enterprise deployments. Secondly, intense competition from incumbent megacap CRM providers cannot be ignored. These players could leverage bundled pricing to defend their market share. Thirdly, as the company expands into the EMEA and APAC regions, execution risk and currency headwinds could pressure margins. In our bear case model, if the customer acquisition cost spikes above $15,000 due to increased marketing friction, we could see margin compression that would delay the trajectory towards steady-state operating profitability. Synthesizing our DCF model and relative valuation, we arrive at our base case 12-month price target of $36, representing roughly a 60% upside from the current spot price. Our model utilizes a conservative implied terminal growth rate of 3.5% and a weighted average cost of capital of 9.2%. Our bull case price target extends to $48, which accounts for either a strategic M&A premium, as private equity continues to consolidate the space, or accelerated enterprise AI adoption, driving early RPO realization. Ultimately, this hidden SaaS platform offers Tier 1 institutional investors a rare combination of structural growth, elite unit economics, and a deeply discounted valuation. We strongly reiterate our overweight rating.